Introduction. Okay, my name's Kurt. I've been trading since '98, and I got hurt really badly in the late '90s. It actually wasn't the crash of 2000. I was actually broke before then, Mike, so I couldn't get hurt too badly. What happened was in late 1999, I had attended some seminars about learning how to do calendar calls and covered calls, and I ended up following my option trading guru's advice to the letter, and it got me completely cleaned out. And so, Mike, what I did was go back to the drawing board and look at the lives of great traders, and I found that they had almost nothing in common. I found that got a little background noise there, Mike. I found that there was almost nothing in common between, for example, George Soros and let's say Jesse Livermore and some of these other well-known great traders. Warren Buffett. They disagreed on what kinds of issues to trade. What kinds of timing to use to get in, when to get out. But one thing that they all shared in common was this concept that I'm going to share today, and it's how to be wrong more often than right and still make money. So I thought that was kind of cool. After learning that, I wrote about it in a blog, and I eventually got asked to write a book. In fact, the folks that were following my blog asked me, look, will you write a book? And I actually collected deposits saying, look, if there's really enough interest, if you put your money where your mouth is, if there's really enough interest, I will write a book. And after collecting several $1,000s, I thought, well, geez, I better start. So so that was the beginning of the Blueprint. That was back in 2002. And since then, we've done a few things. And about 3 years ago, you and I got hooked up. So, Mike, can you tell that story real briefly, and we'll dive in with both feet.
Yes, I'm the Director of Education here at Power Options, and for those of you who aren't familiar, Power Options is a patented suite of search and analysis tools designed for self-directed options investors, and we support over 23 different strategies. And about 3 years ago, one of our customers had called up and wanted a coaching session to learn how to use the historical suite of tools, the backtesting tools, to identify potential married put positions in a unique setup. And when I first saw the setup, I said the same thing that some of you might say today when you see it. Well, I understand that you're limiting risk, but you're setting this up in such a way that you're going to need a 10, 15, 20% increase in the stock price to make a dime. So I don't know what you're really expecting here, and there might be better ways to take advantage of that. And of course, the client, who was Kurt, said, well, why don't you join me for one of our free presentations that I host, and I'll show you exactly how I'm going to make money with this position. And I was so impressed with the technique and the approach that I told Ernie Zareno, the president and founder of Power Options, that he should watch this. And he was so impressed with the technique that he decided to partner up with Kurt, and we enhanced some of our tools on Power Options, the married put search, and of course the portfolio tools, to identify income method opportunities for the radioactive trading investors and for ourselves, as both Ernie and I and other staff members here as well trade the radioactive techniques in our personal accounts.
Very cool. Yeah, I'd actually say that that's an understatement, that you added a few features when it came to the radioactive trading techniques. The married put section of your now it's 23 different option strategies that Power Options supports, right? I mean, there's butterflies, there's condors, there's short straddles, and there's strangles, and there's double diagonals, and all kinds of different things that the Power Options platform will support. But on the married put side, there's quite a bit of extensive stuff in there, and of course you're using that in your own trading.
That's right.
Yeah, I would actually venture to say that Power Options is the best choice, not just for radioactive traders, but for traders all over that do options. And that's going to lead me to my first poll here, Mike. One of the things I'm going to mention, the way to get the most out of today is to participate in the polls and the prompts. We're going to have some audience participation here. Also, I'm going to ask that you write down your questions, okay, because it's very likely that Mike and I have anticipated your question.
Mm-hmm.
It's very likely, but it's not a given. So jot your questions down as we go. If we don't answer your questions by way of the presentation itself, we will have a moment to answer questions at the end. Okay, so please hold your questions to the end, and let's participate in the polls and the prompts. And here's the first poll I'm going to give you. Okay,
Mm-hmm.
I'd like to know what kinds of options you're doing now. Okay, option trading, quote unquote, level of difficulty are we participating in now? Okay, and we'll leave that bugger up there for just a few moments. And let's see, I'm going to want to bop out of this and take a look at something else here. Hang on just a second. Oh, interesting. We have a really high number, Mike, today of folks that don't use options.
Mm.
I mean, it's a low percentage overall. It's like in the teens there. But normally in these presentations, we've got folks that are pretty savvy options traders. We've got a lot of folks that do options. And so I am going to address the folks that don't like or don't use options. Okay.
Mm-hmm.
All right. So we get most of our votes in. I'm going to leave that poll up for another 10 seconds or so. Remember, to get the most out of this presentation, you're going to want to participate in the polls and the prompts so that we can address, the particular needs of this particular audience. Okay. This isn't a recording. Although, are we recording this, Mike? Will we be able to show it later on?
Yes, we are, and yes, we will.
Oh, okay, very good. All right, good. Let me go ahead and close this poll here and share the results. It at one point to 15% that said options mean no likey. Now it's down to 12, but that's still a very high percentage. That's a lot of folks
Mm-hmm.
that say they don't like options. Now, Mike, can you think of any reasons why? There's two that I can think of. Can you think of one reason why folks would not be happy with options, would not like options?
Well, probably because they got burned. And the reason why they probably got burned is because they learned just enough, maybe at a weekend seminar that they might have unfortunately paid $3,000 for or something along those lines, or they just picked up a couple of options books or were told they could make a lot of return, but the downside risk or the risk wasn't addressed. So they got burned, but it was due to a lack of education, perhaps, why they got burned.
That's right. Mike, that's exactly the shoes that I was in about 12 years ago. That's exactly the shoes I was in. And so I'm going to mention to folks online that, look, if you've gotten burned by options, I'm going to give you the missing piece of the puzzle. I'm going to go ahead and tell you what I wish I knew 12 years ago. And another thing, too, is that going to that seminar, going to that webinar, I did pay $3,500 to learn the tricks and tips that got me in trouble and cost me much more.
Mm-hmm.
I'm going to say that what we actually have done is reverse the risk that options may present. Okay, if trading options seems like a risky thing to you, what we're doing is we're actually addressing risk first. And it's really interesting, Mike. Recently, I Googled options trading, and there was a site that said 100% per month returns, perfect for beginners. Can you believe that? I heard somebody, yeah, and Google was continuing to run that ad, but they weren't running our ads. And I thought that was really backwards because we got Google slapped. Now we're back online, but they weren't happy with the fact that we mentioned that it was possible to have a position in place that had unlimited upside and zero risk. But I'm going to go ahead and stick by that assertion and show that within this presentation, it's possible to have a position with unlimited upside and zero risk. Okay, and we're going to go ahead and share that. So if that appeals to you, maybe options might be something that you'd like to look back into. Okay, so those of you that said options mean no likey, welcome back. Okay, welcome back. Now, let's see, 59%, our winner here, 59% are doing vertical and diagonal spreads, butterflies, and condors. Okay, pretty cool. Second place, covered calls. That's what I call the gateway drug. Most folks that are doing options got exposed to it in the first place by a covered call trading seminar. And next, of course, long calls and puts and naked puts. Okay, cool. Mike, I'm going to just ask a real simple question. Real simple question. Okay, are you happy with your results? Okay, just thinking about the last 12 months. All right, are you happy with your trading results? Now, answers range from yes, very happy, very, very happy. I'm ecstatic. Great year in 2010. 2011 is looking even better. Or, hey, look, I'm happy with my trading results, but I could stand to be happier. Or how about this? Mixed emotions. My winners were taken down by my losers. So, maybe I'm ahead a little bit, or maybe I'm behind, but not behind by that much. But I have mixed emotions. I see potential here, but I'm not doing as well as I'd like to be. Or, hey, not happy. Overall losses, even with the bull market, in the last year, I've had overall losses. Or finally, at the end, my results sucked. Okay, now Mike, we've got some pretty good participation, but I'm gonna push for 100%. Okay, I'd like for everybody to participate in this poll. We're not going to make these results. Your particular name and so forth is not attached to these results. We're just getting this for the whole group. Okay, and it's shaping up the way that I normally expect. I normally don't expect to see a whole lot of representation on either end of the spectrum, but most of it concentrated in the middle. Let's go ahead and close the poll and share the results now. Okay. Mike, the biggest result is what?
Well, the biggest result is mixed emotions. Winners taken down by the losers, unfortunately. So we had some winners. We saw some good opportunities. Maybe we're trading a strategy that looked like it was working out over a 2, 3, 4 month period, and then all of a sudden, after 1 month, we're back to maybe square one.
That's right. Okay, that was mixed emotions, I had somebody tell me, man, I'd rather take a physical beating than take a beating in the market. And that was my radio producer. Yeah, if you have mixed emotions, I'm going to say we want to be clear. We want to be clear about our direction in the market. 13% were clear, but not in the best way. They were not happy. They had overall losses. But 31%, 3 out of 10, say that they were happy, but they could also stand to be happier. So, Mike, let's explore that. Okay. In this webinar, I'm going to make a bold promise. Here's my bold promise. I'm going to show you 2 riskless spread trades that can capture much more of a premium and much more growth than a covered call, for example. Okay. That's one bold promise, and in fact, I'm willing to bet that you'll take a look back and wish that you had done it sooner. Now, when I say riskless spread trade, that is something that, alarm bells are going off. A lot of folks think, what? How can you have a riskless spread trade? But, it's true. It's possible. Now, these 2 plays are only 2 out of the 10 income method adjustments that are described in the blueprint. And, of course, folks, to pay the bills here, I'm going to show you two of these for free, but to pay the bills here, I should mention that I've got a book for sale, okay? The blueprint is my flagship product. Okay, it's available on radioactivetrading.com, and that is why I'm able to do these free presentations twice a week. Okay, but folks, the presentation is going to be 97% meat and potatoes, content, stuff that you can use, and then 3% promotion. Okay, I am going to mention where you can go get the book. Okay, so today we're going to do income method number 5, the money net, and income method number 3, the bulletproof vest, and then I'm going to come back after answering some questions. I'll go ahead and show the 3 principles at work that make these, work for you. Okay, now one of these methods is for improving your potential returns better than selling covered calls, and if you're not familiar with options, that's just that's a way of, some folks call it renting out your stock. Okay. It's a way to collect some premiums while you're sitting on the stock, but this method has the potential of returning a lot better. Okay. The other method is something I call bulletproofing, and we actually have a number of ways to bulletproof a stock, but this particular bulletproofing method leaves the upside open, but also makes you invincible. In other words, heads you win, tails you can't lose. Okay. Kind of a cool deal. All right. They say that if you give a man a fish, you feed him for a day, but if you teach a man to fish, you feed him for a lifetime. And we're going to give these strategies away for free. I'm going to point out the difference that knowing these 2 techniques mean in dollars and cents. And I will have given you the strategies at no charge. Here's my challenge, okay? If you feel as though I've given you something valuable, all I ask in return is that you think about investing in yourself to learn more. Okay, so you're not committing to anything, but I do want you to think about perhaps picking up the blueprints if you haven't already, if you feel as though what I've given you is worth something in dollars and cents. In fact, worth more than what we're charging. Okay? Does that sound fair enough to you there, Mike?
I think that's fair enough deal. Yes, sir.
Okay, very good. Okay, folks, everybody's heard this little chestnut: cut your losers short and let your winners run. Have you heard that before, Mike?
Yeah, it sounds a lot like buy low, sell high, doesn't it, Kurt? That'd be great. We'll just do that and we'll make money, won't we?
Yeah. When I first heard that, I was like, I think 8 years old or something. I had been talking to my dad and folks at school, because I was in a kind of a gifted program, and they talked about stocks, when I'm in third grade. And they said, not cut your losers short. They said, buy low, sell high. And I said, wow, I can't wait till I'm an investor. I'll just do that. Well, we found out, didn't we, Mike, that it's a little harder to do that than it sounds, right?
That's right, unfortunately.
Okay, but this cut your losers short, let your winners run, this is something that we can actually guarantee that we'll do. It's not something that we always do, but it is something that if we desire to and use the proper setup, we can guarantee that we'll do this, okay? Now, I'm going to, before talking about that, I'm going to talk about the opposite of that. Okay, let's take a look at covered calls trading. Mike, does this cut your losers short and let your winners run?
Just looking at that basic profit and loss chart, no, it's reverse of that idea, isn't it? It looks like it's going to cut our winners short, and it's going to allow our losers to run potentially.
That's right. Mike, out of your years at Power Options, you've been working there how long? 8 years? 9 years?
8 years now, yep. Going on 9, but 8 years now.
Now, one of the strategies that's supported by Power Options, there's 23 different strategies, but one of the strategies that's supported is obviously covered calls trading. What's the biggest complaint that you hear in a bull market? What's the biggest complaint that you hear from customers, not about, Power Options, but about the covered calls strategy? What's the biggest complaint?
In a bull market, they're happy with the returns they're getting assigned, perhaps, and earning their 2.5%, maybe 3% return on a regular basis. But they're doing it on stocks that are going up 8, 9, maybe even 10% over a 40 to 60-day period. So sure, they made the return that they might have been looking for, but they picked the right stock, just didn't take advantage of that full bullish move. The winners are getting called away from them at a lower price, in other words.
It's acting almost like a sorting machine, isn't it? I mean, you get to keep the losers in your account. I mean, if you buy stock and sell a covered call against, and the stock goes down, well, sure, you get to keep the premium, but you also get to keep a losing stock. Mm-hmm. But what about the winners?
And they're just getting called away from you for a smaller potential gain.
Right, okay. So I am going to say, now this isn't my propaganda here, okay? Here on the screen, what I'm showing is what's available at most options trading sites, the free education portion. This is particular ones from Options Express. I have to agree that the market outlook is bullish, okay? You wouldn't sell covered calls unless you were happy owning the stock and also happy at selling it at a higher price, okay? It's overall bullish because the major component of it is ownership of stock, right?
Right, correct.
Now, I do take issue with this where it says that it's safer because I got hurt trading covered calls. And part of the reason I got hurt was because I was following my option trading guru's nonsense advice, and he had said, hey, to really do well, you should trade on margin. And I did, and that was a bad idea. I ended up getting hurt really badly. Okay.
But, even the position you were in, if you had traded it without margin, it still would have had, 30, 40% loss on it regardless.
Right, that's right. It was a Lipo, L-I-P-O, and I had bought Lipo at, it was a pharmaceutical company. I had bought it at $17, and it opened the next day at $9.
Yeah.
So, so not a happy thing. Now, when you're on margin, that hurts really bad. Mm-hmm. But even without margin, that's not a happy thing. Okay. Now, the reward, I will go along with this. It says that the reward is limited. Okay. So yes, we're going to cut our winners short and let our losers run, and that's the idea of the covered call. Now, how about spread trades? Our number one, what do you call it? poll result.
Right.
Yeah, was look, so 10 are using these types of strategies: vertical and diagonal spreads, butterflies, condors, things like that. Okay, now out of spread trades, most spread trades. Okay, there are some spread trades that that do have unlimited loss or unlimited gain, but most of them have the feature of dialing in a loss limit, but they fail when it comes to letting winners run. For example, Mike, in this bear call spread, all right, we're bearish on the stock, right?
Yes, we're going to make a profit if the stock goes down in price or stays down below that elbow, the strike price of the call that we sold.
All right, let's say that it's a $50, $55 bear call spread. For example, I've sold the $50 call, and using some of the premium received, I buy a $55 call. And so if the stock is below $50, if the stock is like $49.99, I'm going to have the maximum profit, yes?
That's correct.
All right, but what if I'm really right and the stock goes down to $40? Do I make any more?
No, you still make just the maximum net credit you received divided by the difference in strike prices. So it could drop to $2 per share, and you're still just going to make the net credit.
Well, wait a minute. What if the stock goes down to $0? Okay, surely I'm going to make some more money then.
No, it's limited to the credit you receive between the strike prices.
Yeah, okay, so the sense is here that it won't let my winners run. I will win if I'm right about this, but the winners just can't, continue, okay? I can't make a whole lot of money with that. Okay, but I get this weird idea, Mike, that perhaps limiting the downside, limiting the risk, but leaving a side open was a way to go. And it turned out over the next few years that I was right. What happens is in this particular bullish trade, and you could also do this in a bearish sense, okay? But I'm just going to talk about bullish trade. I own stock, and I also own a put option, right? It's still net bullish, wouldn't you say?
Yes, overall we are bullish because, again, the stock incorporates most of our holding.
Right. Okay. Would you go along with this that it is safer?
Oh, absolutely. We have a floor on the downside now. So we are long stock, and the risk with being long stock is that the stock declines 20, 30, 40%, and you're on the hook for that loss. But by entering the position in this fashion, we have put a floor on how much we can risk on the position.
Right. But this is something this is the first time we've seen this, okay? Unlimited potential reward. We haven't seen that yet, but we do see that with a protective put or married put or a long call trade. We see unlimited upside potential. So is this congruent with cut your losers short and let your winners run?
Well, it's not only congruent with that, Kurt, when we're long stock and we are also long a put option for protection. It's congruent with that, but we're also forced into it, aren't we? We're forced to cut our losers short and to allow our winners to run.
Yeah. So, if we're going to actually follow that saying, that trader's maxim, that all the great traders whose lives I studied were following, okay, and using, wouldn't it be nice to make ourselves do it? That's kind of the premise, okay, of radioactive trading. The first principle, anyway, which is force ideal size trades. Okay, we want to make ourselves not risk too much, but leave our upside open. Okay? All right, so are we ready? I'm going to take a second right here, and I'm going to solve the biggest problem that most folks have in their trading. Okay, and then we'll see a practical way to achieve it. I'm going to ask, what single thing do you think you need to be more successful at trading? Mike, we had a lot of folks with mixed emotions. A very, very small amount were pleased with their trading, but still said, geez, I could stand to do better. I could stand to do better. Okay, and we had some folks that were ready to quit. So I'm going to ask, what do you think you need? Do you need more time, spend more time with your stock selection? Do you need a more reliable system for timing your trades? What if you could just spend more time trading? Would you like more time in front of the screen? Okay, or would you just, a loss management method? If when you were wrong you didn't lose too much, then you'd have more left over when it was time to roll the dice again, right? Or, geez, if you could only make your wins bigger, that would do the trick. Okay, so it's populating. We're getting a lot of answers here. It looks like nobody wants to spend any more time. But, oh, we do have a couple of folks that say they want to spend more time trading. Okay, that just came in. I'm going to leave that up for another 5 seconds. And again, I'm going to push for 100% participation. We need you all to do this. Not for me, not for Mike either. Although we do guide our presentation based on what y'all are saying, as far as what your needs are. This particular question is more of a, it's not rhetorical. What is it?
Well, it's educational. It's when you just break it down to your first instinct, when you look at this poll as an investor, what do you think you're going to need to do to be more successful at trading? What do you honestly think you're going to need to do to be more successful at trading? And then we're going to talk about each one in a sense.
That's right. Okay. Looks like one of them we're not going to talk about, and that is need more time with stock selection because nobody picked it. But 17% believe that they need a more reliable system for timing. Okay. 6% want to spend more time in front of the screen. You know what? I want to spend less. I want to spend less time trading. Okay. And I'm a trader, but I want to spend less time trading because I've got better things to do. Okay. 6 out of 10, Mike, actually a little more than 6 out of 10 said, what did they say?
We want to spend, I'm sorry, just backed out of my own brain there, I apologize. We wouldn't mind losing if we lost less, if we kept our losing positions down to a minimal, manageable level. We wouldn't mind losing now and again.
That's right. And then 17% said if only I could make my wins bigger. Now, Mike, I can't help anybody with stock selection, okay, so that's out. And I can't wave a magic wand and give you more time in your day. Okay, so that's out. As far as a reliable system for timing your trades, guess what? I am not your guy. Mike, you know that. I've got lousy timing sometimes. But what happens is when I'm wrong, I don't get hurt too badly. So that we can work on.
Yeah, well, what is the key? Also, if someone wanted a more reliable system for timing their trades, to pick a better entry point at the bottom, let's say, to have bigger gains if the stock moves up, or to have a better timing system to get out of the position when it looks like it's turning against you. In other words, what are they trying to do? Well, they're trying to get a better system to cut their losers short and let their winners run.
Yeah, that's exactly what it is. You see, most folks believe that the answer to their question is going to be in the timing, and it really isn't, because it is impossible to know the future. Okay? But what they're trying to accomplish with that timing system, what they're trying to accomplish is cutting losers short and letting winners run, right? So, okay. So since 78% of our vote is concentrated in the last two answers there, controlling losses and making wins bigger, Mike, I actually have the solution there. I think I'd like to go ahead and share that. Do you think our folks would like to hear it?
I think they're ready for it. Yes, sir.
Very good. Okay, let's take a look at a practical way of achieving it. Here's the structure of an RPM, or radioactive profit machine. And I've had a lot of folks look at that and say, okay, Kurt, now that's just a married put. Yeah, it is, but it's also got some different qualities. Okay, so here, for example, I'm picking up on September 14. I'm picking up shares of Altera. Now, Mike, I've done other trades like this more recently, notably Lulu. Lululemon Athletics did real good income method number 5 trade with them here recently. But I like this particular example because of the some of the objections that and examples that we've used with this. So I'm picking up Altera shares at $27.35, and I'm buying a March. Now this is September, but I'm buying a March 2011 $29 put option for $3.50. Now, what is backwards about this?
Okay, well, anyone who's ever read any introductory material or maybe some information that you showed at the brokerage account would define the married put or the protective put as buying shares of stock and at the same time buying a put option that's maybe only 1 month out in time. So if it was September 14th, I might look at the October put, for example, and instead of buying the 29 put, which is in the money, you know, they discuss buying it out of the money. So I might buy the October 25 strike put for only maybe 80 cents. Well, the problem with that approach is if you talk to anyone who's bought long calls or long puts or trades long calls or long puts and or buys options, uses options maybe as calendar spreads, they always say that no. When you're buying, you want time to work in your favor. You want to buy far out in time so that you don't experience the rapid time decay. And you took those principles of option speculators but used it as an insurance. When you set up your married puts, this is the way we open any position. We're buying the stock, we're buying the put at least 5 months at a time. Could be 8 months, could be 12 months, what matches our SIGA model for the position. And we're buying the put in the money. But that looks expensive.
Yeah.
We were adding 350 onto the position, but what are we truly risking?
Well, you know, the true risk is the difference between the total invested and the strike price of the put. Okay, so that would be, in this case, $1.85, and then when you divide this $1.85 by the $30.85 invested, that's 6%. That's almost exactly 6%. Now, I've got a couple of objections to that. I've heard a couple of objections. So let's hear them, folks. I'd really like for you to participate. What objections do you have to this setup? I know that, Mike, you had an objection.
I said
what was yours?
I said number one, that you're adding too much money in the position, and you are not going to make a dime until the stock was trading above 30.85.
Right. Okay. That's one objection that I've heard is, look, Kurt, you can't make any money until that stock goes above $30.85. You know, 'cause that's your break even. Let's look at the structure again. Okay. Here's our total cost of $30.85. Okay. Now we do have this guaranteed exit, granted. So the total amount at risk is only 6% of the underlying capital. But Kurt, gosh, you know, why do you want this stock to have to go up more than 10% before you make a penny? It doesn't seem right. Okay. What other objections are there?
Well, let's go back to my, these aren't the actual prices on September 14th. This is just an estimation. I'm going to find that out in a minute. But I had mentioned that most people who would enter this position might have thought about, oh, I have to buy the out-of-the-money put only 1 month out in time because I'm paying less premium. That put at 350 is too expensive. I need to buy the out-of-the-money. Well, if I bought Altera the same time you did at $27.35, and I bought that 25 put for 85 cents, already I'm risking $235 because the stock has to fall $235 before my insurance policy kicks in. Add another 80 cents, so I'm risking $315 on the position. So
Yeah.
you paid less money, but you got much less coverage. You're now risking 10 to 12% instead of only 6% on your position. And then you have to do that month by month by month if you're going to hold the stock. So you're adding to that risk on a monthly basis. That's not a good approach.
So somebody wrote in an objection that, geez, you know, why not just go out of the money? It's cheaper.
Right, because it's too expensive to buy the in the money put that's far out in time. You're paying what was that, I'm sorry, Kurt, $350?
$350.
Right.
Yeah. And somebody brought up, well, geez, you know, you could only pay 80 cents and get a lower protecting policy. Well, you know, just like any insurance policy, you get what you pay for, right? You know, if you're to buy a $25 put, right, and spend 80 cents for it, you're essentially risking quite a bit more than by going in the money. Okay, and you're going to spend it again and again. Okay, all right.
I was wrong.
Objections?
Well, I was just want to say I was wrong. I'll be fair. Excuse me, ladies and gentlemen. I'm showing right now on the historical tools and power options that 25 put on Altera on September 14th was 30 cents, not 80.
It's 30 cents. Okay. So you would spend $27.35 plus the 30 cents. You spend $27.65, right? And it doesn't kick in until the stock goes down to $25, right? So so the maximum at risk there is $2.65. Okay. Well, is $2.65 more at risk?
Absolutely.
Or less at risk than the $1.85? It's more at risk, yeah? The $1.85. And is it at risk for a shorter period of time?
Oh yeah, it's only, in this case it would have been only 32 days of insurance as opposed to 6 months of insurance. Right.
Instead of 6 months of coverage for a lower price, you're spending more for a shorter period of time. Okay, so it really is not a good deal to go. Okay. All right, so those are some of the objections. Let me go ahead, Mike, and talk about this. If the stock goes up, of course, we're going to do well. If the stock goes down, Well, we can't get hurt too badly. Now, I'm going to pause here real quick, and we're just going to run this poll again. Remember this baseline reading that we had where we said, are you happy with your trading results from last year? This is today's poll, okay? Let me go ahead and hide that. And now we're just going to do a follow-on. And I'm not even going to show the income methods yet. I'm just going to say, if you can keep your wins from last year, but you never had more than 6% of your capital at risk in any one trade, and you diversified so that even those trades themselves were only 1% of your total capital. Okay, if you did that, would that change your picture? Okay, let's think about that. Okay, if you seriously last year never took a loss larger than 6% and you still got hurt, go ahead and tell me. If you reduce all your losses last year, kept your wins, but reduce all your losses from last year to 6% or less, would you have lost less? Okay, or would it make the difference between a losing and a winning year? Or would it put you over from unhappy to happy because you know what, you might have had a winning year but not winning enough? So if it wasn't winning enough, meaning that you weren't happy, would you be happy now? Okay.
Mm-hmm.
Or were you already happy with your trading and you'd be much happier? Okay, so let's leave that up for another 3 seconds, 2 seconds, 1 second, and close. Bam. Mike, I see, by my count, 100% of our audience doing better with their trading if they used the radioactive setup last year. Am I wrong in making that call?
Well, 15% would have lost last year, but lost much less, so they'd be better off. 15%, that would make the difference between a losing and a winning year.
Okay, 46%, so it's definitely better off.
Yeah, 46% would have put them from unhappy to happy, so they're definitely better off. And 23% were happy with their trading, but would have done better. So I'll agree with you. 100% of those who answered the poll would have done better just applying this technique to limit risk on their stock positions.
Right. Now, we haven't spoken about the income methods yet, but what we have done is talk about limiting risk. Okay, so if we simply employed this, where we keep our risk down in single digits, Mike, we're going to do better.
Mm-hmm.
Okay, but then what about the upside? It is possible to do well. Okay, now I've had some folks object to this about this break-even line. Remember that break-even where it was $27.35 for the stock, $3.50 for the put. So it's, Kurt, you can't make any money until the stock's at $30.85 or higher. Well, is that necessarily true?
It is true if you held the position all the way to expiration. In the case of Altair, it was March expiration. If you made no adjustments on the position,
right,
and the stock was trading right, and the stock was trading right at 30.85, you'd be at break even. Those three things would have to be satisfied. There's a gentleman that asked a question that came in, and he wanted to know, I don't want to tie up my capital. I like your approach, but I don't want to tie up my capital for the whole 6 to 8 to 10 months. Would I be better off just buying a 2-month output? Well, you see, the problem is when we open the RPM position with the 6 or 8 or 10-month output, we're not down the 6% from the beginning. We didn't just drive the new car off the lot. The only thing we're losing when we open that position is the difference between the bid-ask spread. We can still...
Yeah,
go ahead.
I was going to point out something else. I don't have the intent to hold it out for 6 months.
That's exactly right.
I'm just buying the 6-month output. It doesn't mean I have the intent to hold it for 6 months.
Mm-hmm.
So that's a shift in thinking. In fact, continue watching this. Who was it that brought up that idea, that objection?
I forgot the name. I'm sorry. It just came in a little while ago. Hold on. I think it was maybe Lee, I think. Or yeah, it was Lee. I'm sorry. It was Lee. Mm-hmm.
Okay. Lee, keep watching because I don't have the intent to hold this all the way till expiration. Okay, I'm just buying a put that far out because that's the best deal for the money.
Mm-hmm.
And it's kind of cool, okay? All right, so the gap there shows the maximum loss, and the maximum loss could only happen if 3 things do happen. Number 1, the stock is trading below $29, right?
Mm-hmm.
If the stock is trading below $29, then I will lose 6%. Also, if I hold it all the way to expiration, and I've got control over that, I don't have to, and also if I make no adjustments. So let's start talking about the adjustments, okay? Because this gap, we can reduce that gap by taking credits, right, Mike?
Absolutely. We can cut down that original risk, the 6%, by generating income, selling premium.
Mm-hmm. And the most commonly known way to do that is to sell a covered call, but you're going to need the blueprint in order to show you how to not get hung up.
Mm-hmm.
Because if you just simply sell a covered call, you might sell it too low a strike and end up taking more risk than you believe that you are. It's important to understand how to reduce the gap. What I'm going to do is go ahead and show income method number 5 here, Mike. This is, I call it the money net. Okay, or money net number 1.
Mm-hmm.
It's income method number 5, and the reason that I numbered these income methods 1 through 10 is that it's in the order in which I 1 discovered them and 2 proved them with live trades with real money. Okay,
Mm-hmm.
here's the deal, Mike. I buy 1 call and sell 2 at a higher strike. I'm selling 2 October $29 calls at 85 cents a piece for every 100 shares of stock that I own, and that is a $1.70 credit. Now,
Mm-hmm.
there's a problem with doing just that, isn't there?
Well, yeah, if you had 100 shares of stock, Kurt, and 1 put covering it, if you sold 2 October calls, one of those calls is going to be naked. You're kind of creating a ratio here where you have an unprotected short call, which could result in technically infinite losses if the stock just rocketed up in price.
Right, okay. And I am bullish in the first place on the stock, so that's really not congruent. But look at this, Mike. What if I was to buy an October $28 call with some of the proceeds? If I was to use some of that $1.70 that I took in to buy the October $28 call, now would I be covered?
Well, yes, one of your short calls is covered by the shares of stock that you own. The other
Right.
29 short call is covered by the 28 call you bought, but you reduced your credit down to 25 cents, is that?
Yes, okay. I've got a net credit here of 25 cents. So it's 25 cents. Now remember, this is a near-term deal, all right? It's September 24th, right? And I'm selling the October 29 calls and buying the October 28 call, all right? So I'm taking a net credit in the near term against this long-term married put, okay? All right, now, Mike, this is when I did it. And, of course, I'm sorry, this is when I bought the stock, okay?
First one.
And yeah, and the second circle is when I did the ratio call spread. Now, what's going to happen as soon as I sell calls?
Oh, it's going to go up. Stock's got to move up.
Stock has to move up, of course, okay? But what happened, in fact, was I just held on to it, okay, and waited around a little bit, and it was trading higher than $29 on expiration Friday. And as it happened, I did want to keep the stock. Okay,
Mm-hmm.
so Mike, usually with your covered call clients, what do they do if somebody sells a call and they decide that they want to keep the stock, even if the stock goes up? What do they got to do?
Well, we've got to pay into the position. It's usually, if in the case of a movement like this, it would be more than we initially collected. So I have to pay more to adjust the position.
Right. Mike, I'm going to assert that I actually got paid to hang on to the stock. Does that sound a little backwards?
It does.
It does. Okay, so I took 25 cents on the front end, okay, and then got paid to hold on to it, and then it went up from there. So let's see how that worked, okay? Again, September 14th, when I put the position together, all right, the total invested amount is $30.85 per 100 shares. Now, this is scalable. Because the fact is, Mike, rather than buying 100 shares plus 1 put, I bought 500 shares plus 5 puts. Does that make sense?
Understood. Mm-hmm.
Yeah, a bigger fish than me might have picked up, 1,000 shares or 1,500 shares and 15 puts. Okay, but I only wanted to put 1% of my total capital at risk or less.
Mm-hmm.
Okay, so here's the deal. Okay, I had 6% at risk in that trade, and because I picked up 500 shares, it ended up being about a little less than 1% of what I was trading. I was trading a $100,000 account. Okay, so this is the setup. All right, now remember, I said that there were short calls at the $29 strike, but I got paid to hang on to the stock and leave the upside open, and that really doesn't sound right. But that's what happened because I wasn't doing a covered call, Mike. I was doing income method number 5. Let's take a look. On September 24th, I sell 2 and buy 1 for every 100 shares. And in fact, what this was I sold 10 October 29 calls and bought 5 October 28 calls, receiving for each spread 25 cents. Now, that reduces the cost basis of my married put, correct?
Yep, it's down to 30.65.
Yeah, 30.60 actually.
Mm-hmm.
Right. Okay. And I still have the put in place, so in case the stock's price does go down, okay, the most that I can lose now is $1.60, not $1.85, but $1.60. Okay. But here on expiration Friday, the stock is trading above $29. It's at $29.40. Now, on last page, okay, the cost basis for the married put was $30.60, correct?
Right, Kurt. We
Hello?
dropped it down to 30.60.
Okay, and now I'm going to have to pay to close those $29 calls. Now, this is before the end of the day that I did this, okay? The stock was, at the time, it was trading at $29.40, but there was about 15 cents worth of time value and bid-ask spread going on there. So I spent $55 per call that I bought back, okay? So my cost after the buyback is $31.15. Now, take a look here. I still have the guaranteed exit of $29, okay? And my new at-risk amount is $2.15 per share. Now, is that better or worse than the $1.85 that I originally had?
Well, that's worse. This is going the wrong direction, isn't it?
Yeah, that's what it would appear, because I've put 55 cents into the position, and I had only collected 25 cents for doing the ratio call spread. Okay. All right. But we're forgetting something. And here's the deal, okay? On September 1, for every 100 shares of stock, I bought one $28 call and sold two $29 calls. And that's how I collected the 25 cents. Okay? On October 15, I'm buying to close just one call per 100 shares at 55 cents. So yeah, that's a 30-cent net debit, right? But what's remaining? You see, if I've got one long and two short calls and I close just one of the short calls, I've still got one long 28 and one short 29. Okay? Does that make sense? Okay, and I've paid out 30 cents. But I now own a bull call spread, you know, long of 28 and short of 29. And I have financed that purchase by doing the covered call and then buying to close. Okay, so I've paid 30 cents for a guaranteed dollar. Remember, the stock is trading at this point at $29.40, and there's just about an hour left in the market. It actually went up from there. But in the middle of the night, my broker looks and says, okay, Kurt has the right to buy Altera stock at $28. And so he does. At the same time, he says, oh, wait a minute. Kurt has the obligation to deliver at $29. So that also happens without my having to do anything. Okay?
Right.
I get $1. And because I've spent 30 cents to manage the short calls, that's 70 cents caught in the money net. That 70 cents is added to my bottom line per 100 shares. Okay? Or I should say per share, 70 cents. All right? Now, a plain vanilla covered call would have only done net 30 cents if I wanted to keep the stock. Remember? Because the $29 calls had been selling at 85 cents, and I had to buy them back at 55.
That's right.
Okay. All right. So instead of a net 30 cents, I have a net 70 cents. Pretty cool so far? All right. Now, it sounds like you're typing, and I think probably folks have questions. Is there any question I can answer regarding
this is
that
one
before we show the Bulletproof vest?
We're going to save John D's question until the end. But Glenn wanted to know, with income method number 5, when the stock goes in the money, what is the trade-off between buying the stock to cover or buying the short call back? And to me, it depends on the time frame. For example, if you still have 2 to 3 weeks left and the stock went in the money, well, if you buy the stock now at the current price to cover the other short call, you don't have to buy back into the 2 to 3 weeks of time premium. That might still remain on that call option that you wanted to cancel out. However, if you're within the
Right.
last 3 to 4 days to expiration, rather than put another several $1,000s or a couple $1,000s into the position, which would lower your end percentage return because you have to calculate them with your cost basis, it's better just to buy back the call if the time value is only down to 5-10 cents, for example. So that's the difference to me. Kurt, what would you say to that?
Yeah, I would also say that the radioactive trading principle called redline,
Mm-hmm.
which stands for radioactive exponential decay, um, that is taken at full advantage on expiration Friday. Okay, it'd be best to wait and hold this position to see the short calls decay in value as much as possible. And I don't mean the short call itself, but the time value that's a part of the short call's pricing. If that decays down to nearly zero, here it's 15 cents. Okay, if it decays down to nearly zero, you're going to do better.
Mm-hmm.
Hope that made sense. Okay, so Mike, that's what we've done so far. We've reduced the cost basis, and so after closing one short call, here's how it went. Remember the adjusted cost basis after doing income method number 5, the money
Mm-hmm.
net? It had been 30.85 for my stock protected by a put, but now it's 30.60 because I got a 25-cent credit. Okay, now I spent 55 cents to manage the call, one of the calls. All right, but in the middle of the night, my bull call spread closes in the money, and so now we're reduced to 30.15. That's my new cost basis. I still have the $29 put in
Mm-hmm.
place. Okay, so now my cost basis has been reduced, and now my at-risk amount is reduced. Okay. Now we're going to talk about bulletproofing. Okay, I'm going to show income method number 3. Income method number 3, the bulletproof vest. I did this also on the same day. The March $29 put options had come down in value. Remember we spent $3.50 for that insurance policy?
Yes.
Okay, now it's only worth $2.52 on the bid. But wait a minute, that's a loss of 98 cents, but the stock had gone up by $2.
Mm-hmm.
Also, I've collected 70 cents in premium because of income method number 5, the money net. Okay, so for me to sell this, it's not really a loss at all. It looks like I've lost 98 cents, but in order for that to happen, the stock had to go up by $2, and I had to collect 70 cents in the money net.
Mm-hmm.
So check this out. I'm going to swap it. I'm selling the March $29 put, but in its place I'm buying a November $30 put. And I'll explain why I did this in just a moment. But take a look at this, Mike. Is this a net debit or net credit?
Well, this is going to be a credit, Kurt. You're collecting $2.52, and you're taking some of that to switch your insurance policy to a shorter time frame and a higher strike in this case. So you're going to generate 90 cents of net credit into the RPM position.
Right. Okay. I'm collecting 90 cents to do this. Okay. And I've already collected 70 cents from the money net. All right. So here's the deal. Okay. After income method number 3, remember our cost basis after income method number 5, it had been 30.85
Mm-hmm.
for the stock and the put, but I've reduced it by 70 cents, so now it's 30.15. Okay. Then I collect 90 cents for changing my put option, changing my coverage on my insurance policy. So now the new net cost basis for both stock and put, not the old put, but a new put, okay? But my net cost basis is $29.25, right?
That's exactly right. Mm-hmm.
Okay, and for that I own 100 shares of stock, and I also own a put option. And it's scalable, of course. In fact, I own 500 shares of stock and 5 put options. But the net cost basis is $29.25, but that put strike is $30. So what's my risk now?
Well, the risk is negative, isn't it, Kurt? You have invested $29.25 into the position, but you are guaranteed an exit at $30, even if the stock, Altera, dropped down to $1 or $2 per share. So you have a negative at-risk amount, which means you're guaranteed a profit of 75 cents in the worst-case scenario, but you still have an unlimited upside on the upside. Unlimited upside profit potential on the upside, I should say.
Right, bingo. I mean, the thing is, right now, I have a negative at-risk amount. I can't possibly do worse than to earn 75 cents a share. That would be the worst case scenario.
Mm-hmm.
And now remember, a few moments ago I said I would tell you why I swapped the March for the November. The thing is, I had the bulletproofing opportunity, right?
Mm-hmm.
And November expiration happens after November 4th. You know, it happens, I don't know, it's the third Friday in November, and I don't remember what the date was. But November 4th is when Altera was coming out with its earnings announcement. Now, Mike, I wanted the benefit of an uptick in the stock price if that earnings announcement was good. But I also didn't want to bite my nails down to the second knuckle the night before, worrying if that earnings announcement might disappoint.
Mm-hmm.
Okay, so guess what? Right here, I've actually guaranteed myself a profit, and I'm going into the earnings announcement with great expectations, but with no worries at all. Okay, so we have a bulletproof stock. All right. Like I claimed at the beginning I would show.
Mm-hmm.
Got a bulletproof stock, and we've reduced our gap to less than 0. Okay, we can't possibly fail.
Right.
Okay. Now here's what happens. Okay. Oh, by the way, before I tell you what happened, can I point something out? Do you remember when the original setup was $30.85? What was everybody saying, or what were you saying 3 years ago when you first saw this kind of thing?
Well, you're not going to make a dime until the stock's at $30.95. We're not going to make any money until the stock is trading above $30.85.
Right. But that's not how it works out. Even casual observers would say, Kurt, you can't make a dime until your stock hits $30.95. But the fact is, my stock was only at $29.40 at this point.
Mm-hmm.
Yeah, it went up, but it went up at what, $2.05? But by that time, it wasn't, oh, Kurt, you're making a dime. No. By that time, I'm guaranteed to make 75 cents a share if the worst possible thing happened. And if the best possible thing happened, the upside's left open.
Right.
And as it turns out, okay, that earnings announcement was positive. The shares of Altera went up and ended up making $3.85 a share because I held on.
Mm-hmm.
All right. So now that ended up being times 500 shares. That ended up being a pretty good return, over $1,900. All right. But the best part about it was only having 6% at risk. Can you imagine trading Altera, pretty volatile stock? Can you imagine trading Altera with a trailing stop loss of 6%?
I can imagine doing that, sure. But I can also imagine getting closed out of the position in the first hour, or maybe even the first 2 or 3 hours of the trade.
Right. I had something better than a stop order in place here, right?
Exactly. You were guaranteed an exit. Stop losses are fickle. They can be violated very easily if there's a gap down or a sudden shift in the market price. However, this guarantees us an exit. And I'm sorry, real quick, Kurt, Leo just pointed out, or Leo just mentioned, I don't know if you have the numbers on this one. I think you did on the Lulu trade that we share with everyone and some of the other previous webinars. It's Leon, I'm sorry. Leon said, oh, yeah, so you've got that assuming no commissions.
Oh, okay. Yeah, I'll go ahead and take into account commissions, okay? So here's the deal, the summary. I never had more than just under 6% at risk,
Mm-hmm.
okay? By doing income method number 5, I collected much more premium than a covered call would have. And by doing income method number 3, I made myself invincible and did it right before an earnings announcement, okay?
Mm-hmm.
So that's the summary there. Now, dollar-wise, I cashed in the stock at $33.10. Okay, so I made 12%, and in fact, after counting up all the commissions, counting up the commission for buying stock, for buying the put, for buying calls and selling calls against, for closing that call, and Mike, for manipulating the put, all right, with income method number 3, after cashing all those commissions, it reduced my return by 0.1%. Pretty cool.
Mm-hmm.
All right, so that was the deal. Now, if you're trading a smaller amount and did all those transactions, it'll be more substantial, okay?
Yeah, if
But
I did
with
just 100, you were doing 500 shares and 5 puts to begin with. If I followed you in this trade and I just did only, 100 shares and 1 put, I might have still made 12% on my investment, but after commissions, yeah, that might have dropped down to maybe 10.5, maybe 11%, sure.
Sure, exactly. Okay, so commissions are a part of it, but you know what? Commissions are a part of any trading that you do. So, you know, I want to compare apples with apples. Okay, so it was 0.1% did go to commissions. But the really exciting part was that I was guaranteed a return well before the stock hit that so-called break-even point, okay? The $30.85
Mm-hmm.
that most folks and in fact, Mike, even you 3 years ago when you looked at my setup, you said, wow, you know, you can't possibly make any money unless the stock goes up dramatically, and even then you don't make much. Well, that's not exactly how it works, okay? Using the income method adjustments and also the way that a far out in time put behaves is different than a lot of folks expect, okay? All right, so being bulletproof going into earnings makes for great nights of sleep. How would you all like to do that? So let me go ahead and run another poll here, Mike. Okay. Do you remember this poll that we did here where we ended up with 100% of attendees doing better if they just followed the risk management setup?
Yes. Mm-hmm.
Oh, okay. Now that was before we showed the income methods, okay, and bulletproofing. But I'm going to ask, could you put a dollar amount to how much better you would have done last? And the answers range from, well, I can't see how forcing yourself not to risk too much could even help, to this information would have made at least a $10,000 difference.
Mm-hmm.
All right, so that's our range. And let's go ahead and let that list populate. And I'm going to go ahead and answer a couple more questions, Mike, as those questions come in. But we also want to pay the bills here and give an ad for the blueprint and for the Power Option service. Okay. So we try not to sneak up on you. I tell you, I'm really honest about that. Hey, you know, this is why I'm able to do this for free. So, but hopefully you also learn some things from this free presentation that are going to be worth dollars and cents to you. Let's go ahead and close that poll, Mike, in 5 seconds.
Mm-hmm.
3, 2, 1, stop. Okay. I'll share the result. Okay. So, Mike, 6% of our trading audience didn't get it. They didn't see that forcing yourself not to risk too much could even help. Okay. But the other 94% can see that, you know, forcing yourself not to risk too much would do well. Okay?
Mm-hmm.
31% would have saved at least $350 on the worst trade last year. So, Mike, I put that in there because the cost of the blueprint is $350. Okay, so that's really easy. 38%, I would be ahead of last year's results by more than $1,000. 13%, $5,000 to $10,000, and another 13% would have made at least a $10,000 difference. Okay, so I've paid for your blueprint, at least for 94% of you. I've paid for your blueprint with just the setup, not even the income methods, but just the setup. Okay, all right. Now, I'd like for you to what you thought about the methods out there, and also what you appreciate most about today's seminar. Do you appreciate the fact that it was free? Did you like the first part, limiting your losses? If you limit your losses, the rest almost takes care of itself. How about that income method that didn't cap the upside? You know, after I did income method number 3, we didn't have a cap on the upside. There was no short calls limiting the growth of the stock afterwards.
Right.
Right? So it could go up as high as it wanted to, but I also couldn't lose. For example, bulletproofing. Do you like the idea of taking a trade from low risk to no risk and leaving an unlimited upside in case of a run up? Okay, so let's see what folks like most about the webinar today. What you learned, what we went over. Oh, and Mike, there is a recording going to be available of this one, correct?
Yes, we are recording this one. It will actually replace one of the existing presentations in the radioactive trading archive. So,
Right. If there's anything about today's presentation that you didn't get, you can do a couple of things. One is you can go and review that video. Another thing is that you can write us at support@radioactivetrading.com. We'd be happy to answer the question. Okay? And of course, if you want a very full understanding of not just these two, but all 10 income methods, and also a deeper understanding of what kinds of stocks to trade and how to protect yourself, you want to pick up the blueprint. Okay, Mike, I'm going to go ahead and close this poll and share the results. Number one answer here is bulletproofing, taking a trade from low risk to no risk. Very, very cool. Okay, in case you missed it, I just gave you the secret to success in the stock market. Mike, I actually have as many winners as I have losers. I looked at my record here recently and it was 50-50. But if you make dimes and you risk nickels, you can be wrong more often than right and still make money. Isn't that true?
That's exactly right. Yes, I can be wrong more often than right and still make money on the position when I control my risks and still, allow my winners to run.
Okay, let's review the benefits of trading radioactively. Number one, it's an overlay onto whatever trading you already do. For example, Mike, you pick different stocks than I pick, and you have different holding periods than I have.
Yeah, because of my account size, because of my personal goals and my expectations, I'm using the techniques, but I'm not using your stock selection process that you mentioned. I'm using what has worked for me in the past markets and the types of stocks I like to trade based on my account size.
Right. So rather than being a whole new trading system that you had to learn, and by system what I mean is your entry signals, your exit points, the types of stocks that you like to trade. Instead of changing all that, all you've done is just learn a loss mitigation technique, right? And some techniques for bringing in some cash. Okay. Here's another benefit: the losses are controlled from the beginning. Okay. It wasn't remarkable that I made 12%, or let's be honest, 11.9 after commissions. It wasn't remarkable that I made 11.9% in 6 weeks. What was remarkable was that I couldn't possibly have lost more than about 6%. And after a certain point, I was bulletproof. In fact, for most of this trade, I think I was bulletproof. Couldn't get hurt. So that's kind of cool. Okay, bulletproofing, big benefit. All right, it's scalable. Mike, somebody with a smaller account could do this with 100 shares. When I first discovered radioactive trading, when I first discovered the principles and started to apply them, I bought. I only had $2,500 in my account. This was back in 2002, and so I bought Amazon at $16.09, and I bought a put option that was in the money and far out in time for about $7, and I ended up seeing Amazon quadruple.
Right.
If I had sold a covered call, I would have felt like a real chump. Okay, but instead what I did was I had an insurance policy in place, and Amazon went bananas. Okay, well, I did that with a very small account. I did that with $2,500, but somebody at the same time could have done that with $250,000 and had the same percent risk. It's scalable. So that's kind of a big deal, I think. However big of a fish you are, this fits you. Okay, it's kind of a good deal. Okay, so let's talk about the blueprint, Mike. What you get, what it'll cost, and what you risk. It's for the blueprint, it's $339. Okay, and what you get is 250 pages. I'm going to go ahead and get on here at radioactivetrading.com. Okay, what you get is over 250 pages of how to implement the radioactive trading strategies. Now, here's the deal. I don't want anybody to imagine that you have to read 250 pages before you know anything. After you're about 3 chapters in, you already know how to put together a radioactive profit machine and can begin to use the income methods. All right, but the reason we have so many pages in there is we like to give a number of different examples, and we do a number of different case histories and trades of mine, and also trades of folks that have written in. Okay, and then there's 10 different income methods, and some of them make sense in this market and some don't. So you're going to want to concentrate on those chapters that are going to be relevant to today's market. Okay, there's a special chapter on combining income methods, which, for example, you saw today. I combined income method number 5, management technique, and income method number 3, and made my stuff bulletproof. Kind of cool. We got some bonuses. Okay, first of all, if you want to get, if you want to look over my shoulder and see what trades I'm doing real time, it's only $10 for your first month, and you can wait until you're ready before doing that. You're not obligated to do this, but if you decide that you want to get a subscription and look over my shoulder, see what kinds of trades I'm doing, it's only $10 your first month. Okay. Bonus number 2, Foundations of Radioactive Trading CD. This will talk about some things that aren't covered in the blueprint as far as how to trade multiple positions at one time and how to allocate your funds if you are getting into more than one position. Okay, this is kind of a really important CD. I wanted to make that as an add-on to the blueprint. We finally decided, you know what, let's give it away free. So we used to charge for it. Now we're giving it away with the blueprint. Also, you get a month free to Power Options, which is the service that Mike works at. And Mike, of course, you work for him, but wouldn't you agree that Power Options is probably the best resource for anybody that's going to trade this style?
Yes, I absolutely do, and it's not just because of the criteria that we have more criteria and more flexible criteria for identifying positions, A, that have Kurt's default searches in there, but B, also that you can customize based on your stock selection process and what kind of risk you're looking for. But it's the only place that has, as you're tracking it in a portfolio tool, where you can link to see potential income methods that match the rules in the blueprint, that are close to the rules in the blueprint, so all the heavy lifting is done for you.
Right. Let's see. The last thing, I guess I already got away from it, but the last thing is that we have a guarantee.
That's right.
If you're not happy with the contents of the blueprint, just send it back. Right there, there's a what do you call that? That's bulletproofing right there. Okay, so you could do a bulletproof trade today. You could actually get into the blueprint, find out if it's going to be for you, and make you some money. And if you happen to be wrong, well, guess what? It doesn't hurt you. So here's what to do right now. Go to radioactivetrading.com and pick up the blueprint. Okay, and oh gosh, these CDs that I've put up here, profits with puts and the money nets, those go into greater detail on the trades that I showed today. But the blueprint itself captures all 10. All right, so if you want to pick up all 10 income methods, the blueprint's your best investment. Okay, so what your risk is nothing. You have 100% money-back guarantee, so that's a bulletproof trade right away. And here's the reduction to the ridiculous. Mike, we've got only about another minute and a half, and if there is a question or two, I'd like to answer them.
John's question is important because he contacted me when he was on the webinars last week and also during my Friday session, and he knows my opinion, and we've discussed this, and we've agreed to disagree, so he's asking the question of you.
Oh, go ahead, John.
Well, John's question was, when looking at the 5-line setup, he says, you're buying an out-of-the-money call and paying up for the privilege. The box you're embedding in the position, the 5-line setup, is in essence loaning money interest-free to the marketplace, thereby wiping out any perceived advantage you believe you're creating. So John's a fond proponent of, or he's comparing it, of course, to buying an out-of-the-money long call with the married put initial setup. And John and I had some discussions on this based on capital. And when you said, what are some of the objections, this is why he threw this in there.
Okay, go ahead. Repeat that about loaning money to the market. Go ahead.
That when you buy the stock and the put, you're loaning money into the market and losing the advantage that you're saying that you created, is his opinion, as opposed to just buying the call.
Untrue. Part of the Black-Scholes pricing model is the risk-free interest rate. Okay, and this is a really arcane point. Okay, a real arcane type of a question. But fact is, because the Black-Scholes pricing model takes interest into account, and because the real world also takes interest into account, when you buy a long call, it's assumed mathematically that you have the money to buy the stock, but you don't. And instead, you place most of your capital in an interest-producing instrument and take some of it and buy the call, and that's priced in. Now, when you flip it and when you buy the stock and a put option, it's actually the point that John is bringing up is actually reversed on him, because what happens is you're not paying interest in, you're actually getting a price break that's priced in. It's as though you did put your money on deposit in an interest-bearing account when you buy the stock and buy the put. What that means is there's about a 10-cent or 15-cent or 25-cent, depending on how far out in time you pick up your put option, there's an edge to your trade if you buy stock in a put option versus if you buy the call at the same strike. And I can show that over across a number of examples. So hopefully we've addressed that. Other questions?
Nope, that's pretty much it. John mentioned that he made a reference to Charles Cottle's book, Options Trading the Hidden Reality, which I think you're familiar with as well.
Charles and I are great friends. Charles and I have been guests on each other's programs, and I'm a very good friend of Charles Cottle, and he would agree with me on that point, that you're pricing in your interest if you buy the long call.
Mm-hmm. And I wanted you to just address that, because I gave John my answers, and one of my approaches, one of my ways of answering this, when we get that question all the time from customers, can I do the same thing with just buying a long call? And you do discuss this in the blueprint, and when I discuss that to a customer, I say yes, but only if you're disciplined enough to only do the same call, the same size call that you would do entering the married put, and keep the cash on hold, because the risk is, oh, well, I would have bought the Altera 29 strike call that was 6 months out in time, and so when Kurt invested $3,000, I would have only invested $300. Well, then what do you do with the remaining $2,700? Are you going to go out and buy more calls? Now you've got that full $3,000 at risk in 16 or 12 other call positions, where up front I'm guaranteed not to risk more than 6% of that entire capital I started with.
That's right. I'm not going to argue the point. The fact is that whenever somebody tells me in hindsight, ooh, I could have done so much better, then I point out, well, what if you didn't have the benefit of hindsight? And what if the trade didn't work out? What if, for example, I put in my stock and my put, and I put 6% at risk, and you bought as many long calls as you wanted to, and you risked 100? Now what? Okay, sure, you could have done better with just the calls, but what are you doing with the rest of the capital? If you're going to compare apples with apples, we have to start with the same capital and allocate it in a parity method. And parity means that, in equal in all respects except form. So if somebody's going to buy stock in a put and somebody else is going to buy a long call, in order for it to be at parity, the rest of the funds that they trade has to be put into an interest-bearing account, or it just doesn't translate. It's not the same trade. Okay? All right. Mike, that's all I had for today, and it looks like we've had a lot of real good questions. If anybody has further questions, go to support@radioactivetrading.com and drop your name in the hat. We're going to be sending out some real good replies, and maybe even feature you in one of our blog articles. And I wanted to invite everybody right now to go to radioactivetrading.com or to call Power Options to set up a consultation with Mike regarding the Power Options tools. And you can get 2 free weeks on me with the Power Option tools of how to find and also manage these kinds of trades. Okie dokie.
And the consultation is not advice. I will not give you trading advice on a particular stock, security, or option to trade. The free coaching sessions we offer are discussions on how to use the tools. We can discuss strategy, but I will not give any advice on a particular stock, a particular strike price on a stock that you hold if you're considering it. I cannot do that. I can walk through the risk reward. I can walk through the math with you if you're considering one position over the other. But I can't give any direct advice on any direct positions, what you should do with your trading. I am not a financial advisor. I just want to teach you how to use the tools and discuss with you some of the benefits, potential of radioactive trading, how it compares to other strategies, and what it can do for you.
That's right. Very good. Okay, gang. Thanks for coming, and we'll see you out there. Mike, I'll see you on Thursday, and we'll discuss some more about how to reduce our risk, keep it down into single digits, and still leave the upside open. Okay?
All right.
All right. We'll see you out there, gang. Happy trading, and bye for now.